Hello there, this is James and you're watching hashtag Ask James. In today's episode, we're going to do the topic of introduction into moving averages. But before we get into all of that, don't forget these little videos are for educational purposes only and in no way whatsoever should ever be taken as financial advice. I always suggest you do your own research and do your own diligence. And of course, know the risks at hand before entering any trade. With that out of the way, let's get started. So like I say, this is Tixee Live presents hashtag Ask James. For those of you who are new to the series, unlike the normal Tixee Live broadcasts, which I do twice a day, this series is purely dedicated to education and explanation. Okay, it's not market orientated like the Tixee Live episodes. And what makes this series special is the topic of choice is chosen by you good people. So the idea is you send in a topic, hashtag Ask James, of any topic related to the market, and I will dedicate a whole live episode to discuss that topic. And today's topic, like I already mentioned at the beginning, is an introduction to moving averages. So this is a big shout out and thanks to the viewer who suggested this topic, username PipInsight42. So a big thank you to you, sir or madam. Thank you very much for your suggestion, and I'm really pleased to do this topic for you and many others people today. So let's start off with, what are moving averages? Well, moving averages, oops, wrong one. There we go. That's better. Moving averages are one of the most popular and commonly used technical indicators. They are frequently used to smooth out price movements to help you establish an actual trend's direction. Moving averages can also be used to establish potential support levels and potential resistance levels. Moving averages can also be used to identify a change in direction of an asset. Now, moving averages are calculated by taking the average closing price of an asset over a determined period of time. Now, they are known as lagging indicators, as they are based on previous price history. Now, there are two major moving averages: simple moving average and exponential moving averages. Now, for the sake of this broadcast today, because this is just an introduction, okay, this is not a full-blown, education on moving averages, because there's a lot to cover. This is an introduction. For the sake of it, it's just an introduction. We're just going to discuss simple moving averages today. Now, simple moving averages are calculated by taking the closing price of an asset over a period of time and then dividing that number by the period of time. Okay, to give you an example. Hello, sir. Hello, Mr. Stone. I hope you're very well. Okay, I would suggest registering an account and talking to one of our agents. And one of the account managers. They should be able to assist you and answer any questions you have in relation to Tixee and trading. And obviously, please come along and watch me in relation to education and obviously market updates, which is what I do. But thank you, Mr. Stone, for coming along. I hope you're well, sir. Okay, so like I say, so to give you an example, all right, you're using a 10-day period moving average. Okay, so when I say time, I mean it could be days, etc. So we're using a 10-period moving average, okay, on a 1-hour chart. You would then add up the closing price, okay, over the 10, okay, that number, okay, so it's basically the closing price of the last 10 hours, for example, and then with that number, you then divide it by 10. I'll give you another example. Using, again, a 10-period moving average over a 30-minute chart. You would then add up the closing price over the last 300 minutes and then divide that again by 10. Now, before you all start, panicking, thinking that, you have to get your pen and paper out and you have to write down all the closing price of the asset over the last 10 periods and then do all the calculations. Don't worry, because the trading platform can already do that for you. And when you do it, it simply looks a little bit like this on your chart, or like this if you use a black background. Now, the question is, of course, how do you do it? You don't have to do the maths yourself, thankfully, but how do you do it yourself? Well, it's simple. Let's go on to my chart here, okay? As you can tell, I'm looking at the pound sterling today, like we all have been looking at the pound sterling today. So what we do, okay, go to insert on the top of your chart like here, okay? Go to indicators. Go to trend, because moving averages help you identify a trend. Go to moving averages, okay? Select your period, okay? Either like say 5 or 10. For the sake of this example, let's choose 10, okay? Choose a color, obviously, the thickness of the line, and click OK. And boom, you have your moving average on your chart. As simple as that. Now, the theory being, sorry, that's a good question. Hello, Mr. Stone. Why is Bitcoin still stuck around the 20? We have a lot of risk-off appetite at the moment. It's favoring better. It's currently, where is it now trading? It's trading at $18,841 at the moment, isn't it? So it's capped at the moment. Don't forget, we have an awful lot risk-off appetite at the moment. A very, 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 very strong dollar. But market capitalization for the cryptocurrency market did go up over the last couple of days, so that's slightly better. But at the moment, it's capped because obviously we have risk off, and the market is very, very nervous. It's still doing a lot better than certainly the sterling is and the euro is. But by all means, I'll talk a bit more about the market and what's happening later today when I do my other tixee Live broadcast around about 2 p.m. But thank you for asking, Mr. Stein. Hope you're good, sir. Right. So, like I say, so yeah, that's how easy it is. Okay, that's how easy it is. Now, the theory behind it is that moving averages can help you determine if indeed an asset is in an uptrend or a downtrend. Okay, here's the theory. If the price action is above a moving average, okay, that indicates a potential uptrend. If the price action is below your moving average, that indicates a potential downtrend. So what do I mean by that? So say, for example, let's have a look at my chart again, okay? So the idea, if the candles, okay, this is the price action, the candles are underneath the moving average here, it's on a downtrend, okay? If it's above the moving average, then it's on an uptrend. If it goes below the moving average, then it's potentially on a downtrend. Okay, this is on a 30-minute chart. Now, there is a danger to this. There is a danger. Oops, wrong one. There is a danger to this, of course. And that is trading is not that simple. It's not that simple. Because if we're just looking at an asset and it's just above the line, we would go, right, it's on an uptrend, so we'll just buy away. Doesn't work like that because trading is not that simple. Or if the asset's underneath the trend line, would it simply let's sell the asset? It's on a downtrend. It doesn't work like that because you have cases of fake outs. And don't forget, as well as that, the market is continuously changing. But you do have what's known as fake outs. And I'll show you an example of a fake out. Okay, I've actually found a good example with it. And this is the Aussie dollar USD. Okay, Aussie dollar USD. Right now, as we can see, okay, as we can see, for a long time here, it's been on a downtrend on a 30 minutes. So each candle, don't forget, is representing 30 minutes. Then something happens in the market. So we have some breaking news all of a sudden, which changes the market's perspective. And suddenly we see a breakout above like this. And we think, right, the direction has changed. The direction has changed. It's going back up to an uptrend. It's time to jump in. Okay, but then it's just breaking news. The market sentiment hasn't actually changed. So what you then find is it hasn't changed direction at all. It then breaks down and carries on again with a downtrend. So you've jumped in thinking the trend, the direction has changed, when really, realistically, the market has just reacted briefly to some market news, and now it's gone back down to the direction it was always going to be. And don't forget, so like I say, this is a 30-minute candle. So downtrend, 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 downtrend for several hours. Then breaking news, spikes up, and then within an hour, it's back down again to a downtrend. So that's a fake out. So how do you avoid fake outs? Okay, not always you can, because obviously the market's reacting, but there is a way which you can better understand if it's a fake out or not, or a change in direction or not. And that is by using more than one moving average. Using more than one moving average. And this is what you then call what is known as a crossover trend, crossover trades. Okay. And this sort of gives you sometimes a more of a stronger indication that the market is actually changing direction or not, and gives you the potential as well to know whether or not to get into the market or not, or close your position if you already got a position in the market or not. Now, this is, again, the general rule of thumb. Okay, and this is what I mean by faster MA and a slower MA. Let me explain that first. Now, a faster MA, okay, is a smaller MA, something which is reacting quicker to the market because it's over a smaller period of time. Let me give you an example. For example, if I was using a 10 moving average and I'm using a 5, the 5 is the faster MA because it's quicker to react than the 10. Okay, so in theory, so if the 5 MA crosses over the 10 MA, that indicates a potential uptrend or change to an uptrend. Okay, and the theory goes on to this: if the faster MA then breaks below the slower MA, so say the 5 breaks below the 10, that indicates a potential downtrend or a change in direction to a downtrend. And this is what we look out for. Okay, this is what we tend to try and look out for as well, and get a better understanding of it. And there's two main things to always look out for. One is called the golden cross. Okay, the golden cross. Now, the golden cross, okay, is again a technical pattern which can indicate a potential bullish rally in the market. And like I say, this appears when on your chart, when a faster MA or smaller MA crosses above a slower MA. So a 10 and the 5 moves above it. Okay, so that's the golden cross. The other one is known as the death cross. And surprise, surprise, it's the opposite. This is when the MA, the faster MA or the smaller MA, crosses below the slower MA. So say the 5 goes below the 10 MA. That's known as a death cross. So let's have a look at some examples. Excuse me. So let's keep with the Aussie dollar, okay, for a second. So we've got which one is this? Let's put in our 2. Let's go with we have a 30 minutes. So let's go with doing let's do a 50 moving average, keep it deep pink. Okay. And then we'll do a 25 moving average, 20. So let's change the color to dark blue so we can see it. Okay. Right. So as you can see, you move it back a little bit so we can get a bigger picture of it. Here we go. This is nice. Okay. And we actually move it from all the way back here. There. Okay. So as you can see, move it back. At this period of time, look. Oops. Go back to that. So as we can see, we're on an uptrend here Okay, uptrend. So it's above both the 50 and 25. Oh, that's a really good point. I've done it again. I keep doing this. I keep forgetting because I'm switching between two different screens. I forget. Let me start again. My apologies. Thank you for pointing that out to me. Let me start this again. My apologies, everybody. I keep forgetting sometimes to add my screen. Right. Okay. So we keep with the Aussie dollar. Okay. So let's put in our indicators. We're going to go with this time moving average. We're going to go for a 50. Okay. So we go with a 50. And then we're going to go with a 20 as well. 20. Change the color as well. There we go. Right. Okay. So remember the rule of thumb. Okay. The faster MA, so in this case, it would be the 20, crosses above the slower MA. In this case, it's the 50, it's the blue line. Okay. It suggests a change in direction and that we're going in an uptrend. So as we can see, this here, as the 20 passes above the 50, we have an uptrend. Okay. And then as we can see here, the 20 passes below the 50, we have a downtrend. Again, the 20 passes above the 50, indicates an uptrend, and indeed we have a mini uptrend. And then the 20 passes below the 50, again indicates a downtrend. Again, it moves above the 50, uptrend, and then crashes below the 50, indicating a downtrend. Now, here's the thing. Again, like I said, trading is not always this simple. Okay, and this actual currency pair gives me some really good things I can indicate to you about this. Okay, because remember what I said at the beginning. This is a lagging indicator, so there is a delay to it because it's based on price action. Now, if we look at this little segment here, if I move in a bit closer here, okay. Now, so which one I was going to say? Yeah, this here. Look. Okay, it's surpassed. I mean, the market started to drop and then it dropped. Okay, so it doesn't it doesn't give you the information ahead of time. Okay, it sometimes can be lagging, and plus at the same time, it doesn't indicate all the time how long. That's a really good question, intraday. I will go through that with you in a minute. It's a really good question. Thank you for that, because I want to do the different time periods as well. Because I look at longer charts as well. I really do. I look at longer time periods. But that's a great question. I would certainly answer that. But brilliant question. Thank you. But like I say, again, it doesn't always indicate to you how long that uptrend or downtrend change is going to be. I mean, for example, here, like I say, it breaks up, but it lasts a good couple of hours. But, it's not as dramatic as this downtrend is, for example. It's not as dramatic as that. Let's look at another currency pair as well while we're at it. Let's look at some more currency pairs as well, so you can see how this is used. Obviously, the cable, which I've been looking at a lot today, like everybody else. I mean, this is my other point. This is the other point I wanted to reach out. This is a perfect example, actually. Again, look, as you can see, there is a big of a boost up there. Okay, indicating a change in direction. It's the asset is still about like I said, we haven't got the crossover after 20 over the 50 to here, so that's too late, because by that point it's then short-lived, and we're on a downtrend again, so we don't get the crossover till later. So this is one of the things you need to bear in mind as well. Had it happened beforehand, again, that would indicate a good change in direction. And again, it's already gone down on a downtrend before it breaks below, so it can be lagging. So this is one of the issues you have with moving averages as well. So that's one thing. So yes, I keep forgetting to put my chart on. Thank you for reminding me. I really do. Now this goes into your question. this question here, because it does depend on your trading style. I mean, at the moment, obviously, I'm looking at a 30-minute chart, so that's sort of short-term trading. Okay, so obviously, if you want to do short-term trading as like scalping, or simply just get into market quickly and get out, then this is what you can use it on a 30 time frame. If you're using on a 30 minutes, I'd always suggest a smaller number, like a 20, 30. But if we're going to go on intraday into daily, like this gentleman's question, I always prefer, because I do a bit of position trading myself, I prefer longer time frame, longer periods. Okay, and that's just me. And like I will point this out as well. It's a great question. I will point this out. I'm talking about my personal trading habits. Okay, because I've said this many times before. Okay, trading is personal. Okay, you got to fit it to your own lifestyle or your own personality. Okay, so what works for one person doesn't necessarily work for everyone. But this is my preference. Again, this is my preference. If I'm doing a daily, and I do look at a lot of daily charts, because I try and look at daily charts for longer periods of time. Okay, what I tend to use, all right, is I tend to use a 50. I forgot to put my chart on again. Silly me. I keep forgetting that. I do apologize. Right. So this is the sterling on a daily. Okay. So I tend to go for, because it's a longer, because it's a daily, I go 50. Nice red one. Okay. I then go for 100. Okay. And I then go for, because I'm looking for the long term, I'll go for 200. So that's my preference. The reason why, because it's taking the closing price over a longer period of time. So that's my preference. Okay. And again, like I say, it gives you, again, because I look at longer stuff as well. I tend to sort of look at both in a way. So when I both see both the 50 and say the 100, so the two faster MAs cross below the 200, that indicates to me that two moving averages is telling me they're changing direction. Okay, so I'm not just relying on one. I'm relying on two moving averages telling me the same thing. Okay, so it's not just reliant on one moving average moving. I look at the two. So again, to give you a better explanation of that, I've got a 200, 150. Okay, I could act here where the 50's crossed below the 100 and the 200. Okay, but the asset's still round about both the 50 and the 100. But when I see the 50 and the 100 both cross below the 200, that gives me a confidence that, okay, this is going to be a stronger downtrend. So that's how I tend to do it. But a very good question. Very good question. Right, moving on. Okay, moving on. This is the other thing about moving averages. They can actually help you identify potential support and resistance levels as well. Support and resistance levels. Because what you can see is sometimes if an asset's changed direction, so like I said, remember the rule, if it's below the moving average, it's on a downtrend, and that moving average can then act. Okay, very good question. I actually tend to use exponential more, to be honest, for an intraday. I tend to use, actually, like I said, this is a great question, by the way. Awesome question. I tend to do I use a lot of what's known as, I'm not covering it in this episode, because like I say, I'm trying to, it's just an introduction, and I'm trying to keep it, a very simple explanation in this one. But I tend to use a lot of moving average ribbons, okay, sometimes. And that's obviously, I then use a combination of simple and exponential at the same time over a longer period of time. So yeah, that's what I prefer to do. But again, what I will do in the future, because this was a great question, and I know there's more. Like I said, I'm just giving a bite-sized piece at the moment, just a bite-sized piece. I will be doing a full-blown educational webinar on all technical analysis, including moving averages. So I will go a lot more detail, and that I will include moving average ribbons, moving average envelopes as well. So I will go into a lot more detail. So yeah, but that's a great question. Thank you. It really is a great question. Okay, right. They can potentially also be used. Okay, again, be used as potential areas of support and resistance. Okay, support and resistance. So say for example, we're back on a 30 minutes. So let's go on a smaller indicator again. Smaller. Actually, before I do that, let me get my chart back up again. I keep forgetting. I really do. I keep forgetting. Silly me. I think I've got a problem with my aircon today, and I think it's really hot. So my aircon's not working properly. So it's frying my brain a little. So do forgive me. Okay, so we got a 30-minute chart here. Let's do a bit more sort of like quick trading, quick bite-sized pieces. So let's do a 5. Make a nice purple color. And let's do a nice 10. And we'll do that in blue. So we can see the difference. There we go. Right. Okay. Now, okay, currently this is on 30 minutes to a shorter time frame. So as we can see, okay, the 5 is under the 10, so downtrend. And as you can see, as it's on a downtrend, the 5 is acting as a potential resistance. You see, as the asset is below, every time it touches it, and then starts to come back down. When it eventually does break the 5, the 10 then acts as a potential resistance. Okay? Then you have the crossover, a change in direction. And guess what? It changes its nature. It then becomes a resistance. As you can see, the asset is moving higher, but every time it comes down to the 5, the market acts and treats it as a support, and it buys in again, like here. And so if it does go through the 5, then the 10 acts as a potential support. It then breaks down again, changing slight direction. And then again, okay, the 5 acts on a 30-minute as a resistance here, but then the 10 acts as a potential resistance. Again, it changes. Again, they change their nature. Again, the 5 is acting as a kind of support. And again, here, it changes its nature. And N, again, as you can see, acts as a potential resistance. Again, it's not that simple. It doesn't always work. Okay, because if it did work, then trading would be really easy, but it doesn't. But it does work, a good amount of time. So this is where, of course, then you've got to input your own risk management program into it as well. But yeah, that's how you can use it for support and resistance as well. And like I say, I keep it all the support and resistance levels I tend to put in. Okay, all the support and resistance levels I tend to put in. I always keep them in if I do, because I do a lot of price action trading. If I put a resistance level in, I always keep, even when it's broken, I keep it, because I then try and keep an eye on it, see if it has indeed changed its nature and become a support, because I know I could potentially see a buying possibility. But anyway, that is an introduction only, okay, into moving averages. Like I said, in the future, I will do a full-blown episode on this, which will be, a proper webinar where I go into a lot more detail on this. And I will discuss, like I mentioned, moving average ribbons, exponential moving averages as well. Okay, I will be explaining that, moving average envelopes, and a lot more detail as well. So don't bear that in mind. You're welcome. I hope that is. And like I say, please keep coming and ask me questions, because this is, I'm here to help express my, my trading habits and stuff. Not to like tell you to do it exactly like me. No, not at all. I want you to take the information I share and discover, your own way and all that, etc. Brilliant, good. I hope a lot of it made sense. Did it make sense? Or is there any other examples you may want me to show you, or like I said, I will do exponential because exponential tends to be the main difference between simple moving average and exponential moving average is the calculation is different. Again, it's not the calculation you have to do. The platform will do it for you because exponential takes more focus on the most recent price action over that period of time. To give you an example, for example, say you got a 10. Okay, simple would simply take all the 10 closing prices, okay, and then divide it by 10. If you do an exponential 10, it will take again all the 10 closing prices, but it will take more of a focus on the calculation on, say, the last 3 closing prices, because that's the most recent of the closing prices. So it focuses on that. So that's how it works. Yes, it made sense. Well, yeah, there is a lot more. Like I say, again, one of the reasons why I wanted to do these episodes, for one, is because I want, obviously I want to do topics that you good people who would be interested in. I like to try and keep it as simple as possible as well. So people have a good understanding of it. And the way I see it, there is not just one magic solution to trading. Okay, like I said in my my episode of #AskJames last week, which was about fundamental analysis. Like I said in there, I said somebody asked me a little while back, is fundamental analysis more important than technical analysis? And my answer to him was no. They're both extremely important. Both needs to be used in many ways. And it's not just fundamental and technical analysis either. There's market sentiment needs to be taken into account as well. That's a serious. And market psychology, where the buyers and, what's happening to the buyers and sellers. In fact, one of my favorite, just to talk about buyers and sellers, one of my favorite technical analysis theories, which I do use. Again, I use it on a longer time frame because that's what I tend to do, is the Elliott wave theory. I really like that. I like that because that shows you where I call it the madness of crowds, where the herd mentality is in both the buying and selling. It's very psychological. So that is something you can take into account as well. So bear that in mind. Just not one thing makes a complete jigsaw puzzle. It takes many pieces to complete a jigsaw puzzle. So bear that in mind. Is there any other questions at all? Okay. Don't forget, like I say, this is just an introduction. Yes, absolutely. I'm a big fan of price action. I'm a big fan of that. And seeing where the buyers and sellers are. I mean, okay, the one, I do like moving averages. I do, but the one thing which I think sometimes let me give you an example. And this is what's, again, because it doesn't always work for me. I know I said I use moving average ribbons, but I know I said I use moving average ribbons, but I think sometimes people can go over the top with their technical analysis in it, and they do too many, and it gets too confusing and too noisy. So by all means, like I said, sometimes I do use the 3 moving averages, and I have used ribbons before, which is like 4, 5. But yeah, it's a great question. You need to keep it simple. I mean, let me give you an example. I've seen some trading platforms like this, okay, and it's okay. I'm not nowhere of like I knew a trader who had this many, and I'm not lying to you, and I just asked him what was he seeing, and again, like I said, it might work for him. It certainly didn't work for me, even though I do use ribbons sometimes. But he had up to about 8. I'm not going to put 8 in, but he had 8 moving averages. 8 moving averages on his chart. And whoa. It looks like a Jackson Pollock painting, doesn't it? How you can read that. But again, that's not, it just doesn't work for me, that. That's just too many. It's too noisy all the time. So yeah, I like to keep simple. Thank you very much, Christopher. I hope you're well. I hope you enjoyed it and you found something useful out of it. I really do. Is there any other questions at all? Anybody else like to say anything or say hello? It does. And then you chuck in Bollinger Bands and all this RSI. It can get a little bit overbearing. Okay, and don't forget, guys, because this is hashtag Ask James. This whole series is based upon topics of your choice. It could be anything. Oh, excellent, brilliant. I'm really pleased to hear that. Thank you very much, and I hope to see you soon. Don't forget, if you want to make a suggestion of a topic of the next episode, okay, by all means, either leave it on the comment section, either on YouTube or Facebook, or you can even here we go. Would you like me to do a topic on this one? Would you like me to do an episode on this? Yeah. Done. Yes, you just did. And consider it done. Brilliant. Okay. That is in the book. So I'll probably do that next week, actually, on the RSI. Brilliant. So we got a topic for next week. And it's going to be, thank you, train and trade. It's going to be RSI. Thank you very much for the suggestion. That's what we're going to do next week, without a doubt. I'll probably do it Wednesday next week. So brilliant suggestion. You're on. You're definitely on. Brilliant. Excellent. Is there any other questions or anything else at all? Manalos, is that your name? Anyway, really nice to meet you, my friend. So thank you, and thank you for your suggestion. It's a brilliant suggestion. Okie dokie, and don't forget, ladies and gents, if you think of a topic later, you can put it in either the comment section on YouTube or Facebook, and I will see it, and I will do it as a topic. But next week's topic is brilliant suggestion, and we will be doing it on the RSI. So I really appreciate that. On that note, if you're watching me on Facebook and you enjoyed this little episode, by all means give us a follow. If you're watching me on YouTube and you enjoyed this little video, by all means subscribe if you like. Hit the notification button so you know next time I'm going live. If you enjoyed this video and found it interesting and useful, and more importantly, it was understandable, then by all means, please give me one of these. It's nice to know that you like what I do. Don't forget, of course, I'm back online again in just over an hour's time to do the latest market update on the next tixee Live episode. Please come and join me for that, because a lot has happened today. A lot has happened, so please come and join me for that. But anyway, till next time, don't forget, these little videos are for educational purposes only, and in no way whatsoever is ever to be taken as financial advice. Actually, before I wrap that up, I've forgotten something. Before I wrap up, big thank you to Mr. Stone, Kevin Stone, SMF 790, Traded Trade, Christopher. Big thank you to everyone, for anyone who interacted and asked questions. I really appreciated it. I appreciated everything. So big thank you for that. Really appreciate it. And of course, again, like I said, I appreciate everybody coming along to watch me today. I really appreciate that. Now I'll wrap up. Like I say, these videos are for educational purposes only, and in no way whatsoever should ever be taken as financial advice. I always suggest you do your own research, do your own diligence, and of course, know the risks at hand before entering any trade. Till next time, every single one of you, trade safe.